If the stock market crashes tomorrow, how much of your retirement money disappears? With the fixed index annuity, the answer is none. You see, today I'm breaking down what exactly a fixed index annuity is, how it works, and the sneaky details that most people never explain. And by the end of this video, you'll know if a fixed index annuity is just hype or if it actually makes sense for your retirement situation. First, I want you to think of a fixed index annuity like this, just like insurance on your money. Because just like car insurance replaces your car after you get in that wreck, a fixed index annuity replaces your account balance if it's in a stock market crash. So when the stock market crash happens, your money's value is always protected. So for example, if the stock market gets a negative 15% rate of return for the year and you're in a fixed index annuity, at the end of that year, you'd still have $100,000 when nearly any other investment would only have $85,000. That's what makes a fixed index annuity so special. Now, just because this guarantees protection of your principal, which is otherwise known as the money that you've contributed to your fixed index annuity plan, this does not mean fixed index annuities have guaranteed growth, only guaranteed protection from when the stock market drops. Now, let's look under the hood how fixed index annuities grow your money. A fixed index annuity has the ability to invest into what's called an index. An index is like a big scoreboard for the stock market. Instead of watching just one company like Apple or Microsoft, it keeps the score for a whole group of companies. And based off how well that index does, your annuity company will credit you the money you earned from that index. There's a lot of different indexes or indices, but in this video, I'm only going to cover a few of the main ones. So first, let's start off with the S&P 500. The S&P 500 is basically a list of the 500 biggest companies in the United States. Think of it like a giant team made up of the country's most famous businesses: Apple, Amazon, Microsoft, and Disney. Those are companies that are in the S&P 500, and most of those companies that are in the S&P 500 are called large cap or mega cap companies. Large cap means they're worth between $10 billion and $200 billion. Mega cap means they're worth more than $200 billion. In other words, these are giant companies that could probably buy a whole city and just use it as their parking lot. When those companies do well, the index scoreboard goes up, which means your account balance also grows. When they struggle, the scoreboard goes down. But remember, if it performs poorly, you have guaranteed protection to not lose money from any kind of market loss. Then we have the Russell 2000 Index, which is made up of small cap companies, which are businesses that are worth about $300 million to $2 billion. Think of them like the small underdogs of the business world. They're not yet like Apple or Disney, but some of them could grow really big, or others might stay small or even possibly disappear. And lastly, there's the MLSB, the Merrill Lynch Strategic Balanced Index. The MLSB is called the Balanced Index because it mixes together two different things: stocks and bonds. Stocks, which are like owning a small piece of a company, and all bonds are loans. These companies say, people in the public, we want you to loan us money, and we will use that money to create more stores and invest into our business. And we'll pay you back the money that you loaned us, plus we'll give you back a little bit of interest. Then they do whatever they need to grow their company with that money. And they didn't need to use their own money because they used your money or people in the public to grow their business. Now, I want you to think of the MLSB like a really nice buffet. Some plates are exciting, some are boring, right? But the whole idea is to have balance. You don't just pile on the cake, right? You're going to grab some veggies, you're going to grab some meat for a balanced meal. The MLSB is built to be a smooth ride because if stocks struggle, the bonds can help, and vice versa. Then there's also called a fixed rate option, and that's one of the smallest options because instead of growing in like a S&P 500 or the Russell index, you could just get a guaranteed interest rate. Think of it like parking your money in a super safe spot. It doesn't matter what the market does, you'll earn a set guaranteed interest rate, and it's not flashy, but it's steady, kind of like eating at the same diner every Saturday where the menu doesn't change, but you always know what you're going to be getting. So just to recap, very simply on the indices, it's like picking out restaurants. The S&P is like a big steakhouse. The Russell, it's like food at a food truck. The MLSB is like a balanced buffet, and the fixed rate is a reliable fast food stop where you order the same thing every time. Here's the key with these indices. You don't actually own the companies inside of them. The index is just a scoreboard that the annuity company uses. So if the score goes up, they add interest to your account. If it goes down, you don't lose money. You just don't earn the interest for that time. But here's the thing though. The annuity company doesn't just hand over the full score. They use things called caps, participation rates, and spreads to decide how much of the growth in the index you actually get. So let's break it down in plain English. First is cap rates. Think of a cap like a lid on a jar. It's the maximum amount of growth you can actually get. So if your annuity has a cap of 8% and the index goes up 12%, you don't get all that 12%. You get credited only 8% in that example. So for example, if you had $100,000 and the market went up 12%, but your cap rate was at 8%, you only get credited $8,000, not 12. Then there's participation rate. This is how much of the growth you actually get to keep as a percentage of the growth. So if your annuity has a 50% participation rate and the index goes up 10%, you only get half of that 50%, right? So on an example of $100,000, a 10% market gain would normally be $10,000, but with the 50% participation rate, you only get $5,000 added to your account balance. And lastly, there is the spread rate. This one works a little bit differently because a spread rate is like a service fee that gets taken off the top of the gains before you're actually credited. So if your annuity has a 3% spread and the index goes up 10%, they're going to subtract the 3% first, and you'd actually get credited the 7%. For example, on $100,000, a 10% market gain is $10,000. But after subtracting the spread, you'd only get $7,000 credited. Here's the key point with cap rates, participation rates, spreads, and all that stuff, is they could change every single year. They're not locked in forever. And the good news is you could usually move from one index to another from year to year. So you're not actually stuck in one place if you don't like that stuff. Now, the other thing is you're not required to invest into just one index. You can actually spread your money out across multiple indices. Now, here's a feature that everyone asks about when it comes to a fixed index annuity: lifetime income. You can turn your fixed index annuity into guaranteed lifetime income. And it works just like a personal pension or like Social Security. And there's actually two different ways you can add lifetime income. And one of the ways is good and one of them is bad. And the bad way is actually what got annuities and pensions in a lot of trouble and a bad name in the past. Now, lifetime income option number one is called annuitization. And once you turn it on, you can't stop it. Can't stop it at all. Okay. And just to be clear, that's not what I recommend, but I see a lot of people get stuck in that option. But because when you annuitize, you can choose to have lifetime income for a single life, which means income for your whole life. And when you die, the leftover money goes back to the annuity company, not to your beneficiaries. Or there's joint life, which gives you lifetime income for you and your spouse. And when you both pass away, all of the leftover money goes back to the annuity company in annuitization. Now, when you annuitize, it's like getting married to your income. For better or for worse, no take-backs. Okay. The dangers of this is if you have single life and you die the day after you turn on lifetime income for single life, all of your money would go back to the annuity company. Or if you got joint life and you guys died a year later, all of your leftover money in your annuity, it goes back to the annuity company. And once you annuitize legally, you cannot stop it or turn it off. Now, the second way to have lifetime income is with something called an income rider. And honestly, this is what I recommend if you want to actually have guaranteed lifetime income. Here's how it works. You pay a small fee each year, usually around 1% of your account value. And in return, the annuity company will give you a lifetime paycheck. So if your account is $500,000, the fee might be around $5,000 a year. So let's say you're 65 years old with $500,000 in your annuity. The annuity company might guarantee around a 5% withdrawal rate for life. That means that you get around $25,000 per year as long as you live. And here's the key part. that check stays the same, even if your account balance drops below $0 because of the withdrawals and the annuity income fee. The annuity company still has to pay you that same amount for life. So you could set it up as single life, which is income for just your life. But when you pass away, the checks stop. And then you also have joint life, which covers, again, you and your spouse. And here's the big difference from annuitization, though. When you use an income rider, if you pass away and there's still money left in your account, that money goes to your beneficiaries, your spouse or your kids or whoever you choose to be your beneficiary. When annuitizing, whatever is left over goes back to the annuity company, which is not good. And that's why a lot of people prefer to have an income rider, because it keeps control of the money in your family, not theirs. Now, one important key takeaway is you have to add the income rider when you first set up the annuity. Usually you cannot add this later. And yes, that's a yearly cost, around 1% on average every year you have that income rider. But for that fee, you get peace of mind and a consistent paycheck for life, and the confidence to know that your money will still go to your family if you don't use it all up. And that's why I usually recommend having an income rider instead of annuitization. Now, let's go over the pros and the cons of a fixed indexed annuity. Pros, number one, no market losses. Your account never goes backwards when the stock market crashes. Number two is tax deferred growth. You don't have to pay taxes until you actually take the money out of your fixed indexed annuity. Number three is lifetime income options. You can turn your fixed indexed annuity into a personal pension or Social Security-like paycheck. Number four is flexible crediting strategies. You can split your money into different indices or even a fixed interest rate each year. And number five is peace of mind, knowing that you can sleep better at night, knowing your nest egg isn't on a roller coaster. And number six, this one's a secret tip. If you choose to not have an income rider, there's usually no fees at all to invest into a fixed index annuity. The cons of a fixed index annuity are, number one, limited upside. You have caps, participation rates, and spreads that put guardrails on the growth. Number two is challenging rules. Those caps and participation rates and spreads can change each year. Number three is liquidity restrictions. You can't just pull out all of your money early without penalties. There's what's called a surrender schedule, which is a heavy fee for an annuity company to charge you to take out more than 10% of your money every year. And number four is complex contracts. There's a lot of fine print, and these can feel like you're reading IKEA instructions. Number five is fees for extras. Income riders and some other benefits come with an added cost. Now, here's the bottom line. A fixed index annuity protects your money from losses on the market downturns, and it gives you the chance to get growth. You don't get all the market gains, but you also don't take all of the market hits at all. It's not about being flashy. It's about giving you peace of mind, knowing that you have steady growth and lifetime income options. Now, if you're ready to see an annuity that could really skyrocket beyond a fixed index annuity and why some people absolutely swear by it, don't miss my in-depth walkthrough on variable annuities. You'll see it on the screen above me here, or you can just grab it in the description below.